Good morning. It is Monday, May 18th, 2026. This is your Deep Dive Daily Briefing. I am your anchor, delivering a comprehensive analysis of the pivotal events that have defined the last 24 hours. We begin our broadcast on the world stage, where the strategic situation in the Middle East has entered an introspective phase following high-level diplomatic maneuvers. The international community is closely evaluating the broader geopolitical fallout of the war, as concrete results continue to emerge from recent attempts to reset relations between United States President Donald Trump and Chinese leader Xi Jinping. This diplomatic window comes at a critical juncture for regional security, as the maritime environment remains highly strained. Despite intense effort, the functional closure of the Strait of Hormuz continues to paralyze commercial traffic, keeping the international community on high alert. The broader implications of this ongoing standoff will be a primary focus for Group of 7 finance chiefs, who are convening for a two-day meeting in Paris starting today, Monday, May 18th, to take stock of global growth and assess the baseline stability of international relations.
Transitioning from the theater of diplomacy to the broader global economy, the narrative is being dictated by an aggressive global inventory race as industries rush to build defensive stockpiles. The latest business surveys and purchasing manager indexes for May indicate that industrial activity in key economies continues to expand, driven heavily by front-loaded stock building on fears of a prolonged energy supply crunch. This defensive maneuvering comes as a response to a third month of war in the Middle East, which has already severely dented output. According to recent gross domestic product data, the euro area economy increased by only 0.1%, with country-level releases showing that domestic demand has been heavily crimped by surging energy costs. Economists warn that this massive rush for raw materials and manufactured goods is feeding pipeline inflation pressures, further clouding the short-term economic outlook and threatening a persistent stagflationary trap.
In the realm of finance, all eyes are on the transition of power at the Federal Reserve as Wall Street navigates a worsening inflationary backdrop. Markets are anxiously awaiting the official swearing-in of Kevin Warsh as Federal Reserve Chair, with Jerome Powell currently acting in a pro tempore capacity after his term concluded on Friday. This leadership transition coincides with mounting internal pressure, as a growing contingent of central bank officials seeks to abandon the traditional easing bias in favor of neutral language that implies the next rate move could be either a cut or a hike. With U.S. consumer price inflation having hit 3.8% in April, the highest level in nearly 3 years, and the benchmark 10-year Treasury yield settling near 4.45%, bond markets remain highly fragile. Institutional investors are fretting over the high probability that near-term energy-driven price pressures will bleed into long-term expectations, forcing the incoming chair to navigate record global debt while maintaining a restrictive monetary policy stance.
Turning our attention to the technology sector, the structural push to secure the core assets required for the next generation of computing is expanding into new frontiers. As tech giants face severe power bottlenecks in traditional infrastructure hubs, the industry is accelerating a massive capital redirection toward both energy independence and critical raw materials. In a strategic corporate alignment, major industry players are aggressively expanding their lithium mining initiatives and refining infrastructure to insulate their supply chains from geopolitical fragmentation. Simultaneously, the talent war for advanced artificial intelligence development has intensified, exemplified by Microsoft adding a significant contingent of former AI-2 open-source model researchers to bolster its superintelligence team. This trend highlights a new operational reality where technological leadership is determined by a dual mandate: securing the top-tier algorithmic talent capable of advancing agentic AI models and anchoring the physical, mineral-rich supply chains needed to power them.
Finally, we look at the logistics and supply chain networks that serve as the vital arteries of global commerce, which are now confronting the operational realities of a multi-month disruption. The prolonged conflict in the Middle East and the ongoing restrictions through the Strait of Hormuz have permanently altered maritime traffic patterns. Shipping lines have integrated the Cape of Good Hope detour into their standard operations, a shift that has absorbed massive amounts of global fleet capacity. This permanent detour has driven a significant surge in Brent crude oil prices, which have recently tested levels above $107 per barrel. Logistics professionals report that the global inventory race is creating unprecedented backlogs at alternative regional ports, as companies abandon the low-cost, just-in-time models of the past decade. The industry has settled into a high-cost strategy of regional buffer stocks,
accepting a permanent cost premium as the baseline required to protect world trade from unpredictable geopolitical choke points.
In summary, the global landscape is defined by a critical G7 meeting in Paris assessing the fallout of the Middle East war, which has triggered a defensive global inventory race and a significant slowdown in economic growth. The Federal Reserve stands on the brink of an official leadership handover amid 3.8% inflation, while the technology and logistics sectors finalize permanent adjustments toward supply chain independence and high-cost regionalized inventory models. Based on the current trajectory, I predict that the economic data released over the next 2 weeks will force the Federal Reserve to formally adopt a neutral or slightly hawkish policy bias. The global rush to stockpile goods demonstrates that corporate leaders have already accepted a prolonged energy crisis as their baseline operating reality. Even if the G7 finance chiefs establish a coordinated response to manage rare earth and bond market instabilities in Paris this week, the structural inflation fueled by front-loaded stock building and high maritime freight rates will prevent a near-term moderation of prices. Consequently, Kevin Warsh will likely assume the chair with a clear mandate to prioritize price stability, ensuring that interest rates remain higher for longer throughout 2026.